Good morning. It's 5 a.m. in New York City. I'm Matt Miller in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Tech pressure waning. Equity futures cool down from days of sell-off. The dollar hits a fresh two-week high. That's ahead of the annual Jackson Hole Symposium kicking off as the latest Fed minutes highlight inflation concerns and retail earnings continue with the biggest in the world, Walmart, as well as Ross Stores on deck today. Let's take a look at what's going on in terms of futures, and you can see that although S&P futures are gaining a little bit more, are losing a little bit more, I should say. NASDAQ futures are down now. They had been up earlier in the session and after the trade last night. Russell futures are down the most right now. So it looks like sentiment is souring as we approach the open, just about 4.5 hours away. For some of the stocks that we want to watch, let's get over to Valerie Teitel. She's standing by in London. Valerie?
Good morning. Let's start with some earnings off the back of Coty's earnings. A surprise loss of 2 cents per share has seen this beauty and perfume retailer conglomerate, should I say, drop 21% in pre-market. Now, Coty owns brands such as Rimmel and CoverGirl. There have been ongoing a 5-year turnaround plan. It still seems like they do have some room to go, but there were some warnings on the consumer on here. They're seeing soft consumer demand, and that is causing a buildup of inventory. Let's move over to the tech sector. Some positive news for CoreWeave. This is the AI data center company that went public back in March, up around 1.5% after some regulatory filings showed that Jane Street has taken a passive stake in the company of around 5.4%. And lastly, Walmart, as you mentioned, the big one on deck today, reporting before the bell. Walmart being one of the largest private employer of Americans, should I say, reporting before the bell, down 1% so far in pre-market trade. Now, note, Matt, that they're previously in their guidance, it was very, very conservative in the last quarter. So there are some bullish expectations and some expectations that they upgrade their guidance now that we have clarity on tariffs. Matt?
Yeah, the stock up 14% year to date. So a little bit of a sell-off in the futures, but investors are definitely positive on this stock. Valerie, thanks very much for that. Valerie Teitel in London. In just moments from now, Freya Beamish of TS Lombard joins us to discuss the Fed's rate path. And then later this hour, we're going to look ahead to Jackson Hole, JPMorgan's Kelsey, Berro. So some important analysis that you don't want to miss. Now, that symposium, as I said, is kicking off later today with Fed Chair Powell set to speak tomorrow on Friday. Let's bring in Jill Deeses for more. Jill, what are investors right now pricing in for Jackson Hole?
Yeah, well, Matt, I think that there's really two things that you really want to look for out of Jackson Hole this week. Obviously, all eyes are going to be on that Powell speech once we actually get to that on Friday. Remember that he's traditionally used this conference to telegraph some news about the Fed's rate trajectory. We saw this a bit last year when we were talking about the beginning of that cutting cycle. We also saw this back in 2022 when we were talking about hikes, and we did see a massive amount of market movement off of that. I think in terms of how much Powell actually gives away this time around on Friday, I think a little bit of that is, less unclear, but certainly we would want to know, whether there's going to be any kind of a hint as to, whether or how much action the Fed may take at its next FOMC meeting next month. So that's certainly a component of this conference. I think, easily the most important one. The other thing that I would ultimately look at too is, certainly there's been a lot of questions about the Fed's independence and how much of a pressure campaign the Trump administration has really put on Powell and the Fed. This is going to be an opportunity for, a lot of the Fed's allies, a lot of his colleagues. You're looking at Lagarde attending from the ECB, Bailey from the BOE, Ueda from the BOJ are all attending. I mean, really an opportunity for those other central bankers to really rally around the Fed and that concept of independence here. Jill,
let me ask you, since you're in Hong Kong, the Fed obviously doesn't operate in a vacuum. I've noticed M2 here in the U.S. is climbing to an all-time high, and our MLive team says liquidity in the Chinese economy is also incredibly high. What does the Chinese economy look like in terms of, how it relates to the U.S.?
Yeah, I mean, I think that at this point, really when you're looking at the Chinese economy, a lot of those issues that the Chinese economy is facing, world's second largest, has undergone a period of economic slowdown over the past couple of years. Certainly, a lot of those issues are specifically domestic or property related. But the way that we look at the Chinese economy, particularly sort of relative to the United States economy, is really when it comes down to exports, impact of tariffs, those kinds of things. That's, I think, where that relationship is really kind of key. And I think, when we're looking more broadly at the U.S.-China relationship, the more important things to keep in mind there are, things like, those tariff relationships. Obviously, we've got that trade truce, sort of spinning out to November at this point. That's where I kind of look at those levels of concern there.
All right, Jill, thanks very much. Jill Desis there joining us out of Hong Kong, taking a look at the Fed and a look at what's going on in China as well. Joining us now is Freya Beamish, chief economist at TS Lombard. And Freya, great to see you this morning. I've been looking at the world interest rate probability function on the Bloomberg, and the percentage chance that futures are pricing in of a rate cut continues to fall. Last week it was 100% and dwindled down to 95%. Yesterday it was 85%. Today it's 80% even. So markets are pricing in less and less chances of a rate cut.
Yeah, it's bounced around a lot, but certainly it's come down since that CPI print, and I think that's the right direction. It's a punt, honestly. September is a punt. They've told us quite clearly that they're not going to wait around any longer if the CPI print comes in and it's still kind of equivocal. You can't really tell to what degree tariffs are coming through. I think if you look under the details, you can see that tariffs are starting to come through, and I would expect that to continue. But if the CPI print doesn't pop between now and then they probably are going to get ahead and cut. Where I have more conviction, though, and I don't actually expect Powell to do a great deal of signaling on September, because the last thing he wants to do is come out and signal, and then the CPI does pop, and then there's just going to be a complete turnaround as a result of that. So where I start to get more conviction is with regards to December. And I think just the backdrop here is looking increasingly inflationary. I realize the pass-through rate has only climbed. We started 5%, 10%, 15%. It's getting higher with each print. I would expect that to climb up to 50% by the end of the year, and that means inflation is going to be moving away from target. Hitting the 3% handle, maybe even going higher than that if we look at the tariff rates that are in the system at the moment. Two major trading partners at 15%, China's still way up there. That's very close to what I would call a tipping point in the inflation regime. You have a low and stable inflation regime and a high and volatile inflation regime. I don't think we necessarily see them signaling anything as hawkish in this week. But where you will start to get an inkling about things and the terminal rate, to the extent that the Fed remains in control of that and independent from now until that terminal rate, is with regards to the research that is going to come out of Jackson Hole, looking at the labor supply and what that implies for NFP break-evens. We're all used to 100 being that moment where that's kind of neutral on the unemployment rate. That's probably because of demographics getting pulled down. I don't necessarily expect them to talk a lot on the immigration side, but the immigration side of it over the course of the next 12 months is going to pull the NFP break-even rate down, on a reasonable assumption to 60, potentially below that, depending on how much the ICE detentions reaccelerate, depending on self-deportations, depending on decline in the immigration rate. And these things all make it easier for the economy to overheat. I think the Phillips curve is probably higher as well. And so if we're already at the top of the Phillips curve that's probably going to be prevailing over the next 10 years, we're going to be seeing domestic labor market tightness more likely to feed through into wage growth, and that probably more likely to feed through into CPI inflation as well. So
Freya, let me ask on the labor market, if the supply side is an issue, and clearly that's been highlighted, what does the demand side look like to you?
Yeah, good point. I think at this moment in time, our call at this stage is that the labor market is on pause. It's not recessionary. It's on pause just because of the degree of uncertainty that's been forced upon the U.S. economy. Now, I would expect the labor market to recover to some degree, but where we have to put the demand side and the supply side back together again is what is that degree that is important for the Fed? If we're seeing labor market prints, if we're seeing the NFP coming in at 100 now, given the demographic changes and given the changes in immigration policy, that's actually pushing us towards overheating, which is a very strange situation to be in unless productivity growth is really picking up. And productivity growth is not going to be picking up. Take it from us in the UK, when there's this level of uncertainty, CapEx just can't get off the ground. Well,
we have CapEx soaring here, certainly on the West Coast, and AI. The great promise of AI is the fact that it can boost productivity. I'm on ChatGPT for hours every day. Not sure if I'm any more productive because of it, Freya. But you don't see that adding to productivity growth, at least in this economy, this exceptional economy here in America?
I think that has been the story already. I think the U.S. economy has broken out in productivity terms over the past, on the positive side, over the past kind of couple of years, under the influence of positive demand shock. So there's a big difference between wage growth as a result of a positive demand shock, so subsidies and putting money effectively in people's bank accounts, and wage growth as a result of a negative supply shock, which is the policy that we're now shifting towards that, tariffs and deportations, detentions. These are negative supply shocks. The difference is that when you have wage growth as a result of a positive demand shock, there's more of a reason for businesses to go out there and invest, both because they see the sales revenue, but also because they want to curtail the unit labor cost growth. That's the key term here in terms of whether we're going to see that CapEx coming through. And I think, the U.S. economy, don't get me wrong, I'm not saying the U.S. economy is done. There's something special about the U.S. economy. There has been for decades and decades. In fact, looking back over a 100-year time horizon, the U.S. economy is freakishly able to sustain 6% returns consistently as a trend basis. What the problem is at this moment in time is that there is this shift towards negative supply shock policy, and that's going to undermine some of the sort of the resilience and the dynamism, I think, of the U.S. economy. It's not to say that it's done. It's just compared with expectations, which is what we care about in markets. You actually can start to get a little bit more positive about the European story, as we've seen this year. We think that's a multi-year story that is based on a strong kind of repricing of the expectations of risk-adjusted returns between the U.S. And the European economy. And certainly that sort of uncertainty aspect is a problem for the U.S. I think specifically on AI, the problem I have with that as a driver of the stock market, in the way that it's been interpreted so far, is that we're trying to extrapolate there. It seems like investors are just trying to replicate the benefits of digitalization, which accrued very narrowly to a select group of firms, the tech firms, onto the story for AI. And actually, I think the story for AI and productivity growth disperses much more into the real economy, which in some ways is a good thing. So there are some definite positives coming through here as well. And I spend a lot of time on ChatGPT with my Python open on the other side as well. And there certainly are a lot of productivity enhancement measures that will come through as well. But that's true as much for an Italian service sector firm as it is for a US firm as well. And if there's a demand-led story there, then that's likely to come through.
Freya, awesome to get some time with you. Thank you so much for joining us this morning. Freya Beamish there of TS Lombard, where she is their chief economist. Let's get to the other top stories trending on the terminal this morning. Fed Governor Lisa Cook has a message for President Trump. She can't be bullied into stepping down. In an emailed statement, she said she had no intention of leaving the Fed despite the president's call for her resignation over allegations of mortgage fraud. A resignation would, if it happened, create another opening for Trump to fill on the Fed board. Shake up on Wall Street. Bank of America announced several leadership changes. Faiz Ahmed and Mike Jew were named the new co-heads of its global investment banking unit. The bank also announced a number of other changes in its corporate, banking, and markets units as they shuffle the decks there. Europe's private sector is gaining momentum. The euro area's business activity grew at its quickest pace in 15 months. Manufacturing exited a 3-year downturn despite the EU-US trade deal locking in higher tariffs for the bloc. Coming up, the path to peace for Ukraine facing some complications. More on the talks between Kiev and Moscow. Next, this is Bloomberg. Peace talks between Kiev and Moscow underway following President Trump's recent interventions in the Eastern European conflict. Take a listen to Vice President J.D. Vance telling Fox News about the progress.
We now have the Russians talking to the Ukrainians. They're talking details about what would be necessary on each side to stop the fighting and stop the killing. We've made more progress in 3 months than the country had made in 3 years in stopping this conflict. And I think it's because sometimes you just need a president who will pick up the phone and call somebody.
For more, I'm joined by Bloomberg International Affairs columnist Mark Champion. And Mark, I've heard general after general on Balance of Power, our politics program in the afternoon, say that Russia is losing this war. Why would Ukraine give Moscow territory it doesn't even occupy?
Right. I mean, that is a red line for the Ukrainians, and they have no intention of doing so. You know, there are multiple problems here. The first is that the Russians are asking for 2 sets of pieces of territory. You know, the first, which they spoke to directly to Donald Trump about, is in Donetsk, and that's where the Ukrainians have a string of fortress cities, is what they're called. And these the Russians have been trying to take since 2014 and have failed to do so. Rough estimates, you know, if the Russians were to continue at their current pace, they might take that area that they're asking for in 4 years' time. Of course, you know, the pace can change. There's a second, much larger group of territories that they are asking for in the provinces of Zaporizhia and Kherson, which is further south and a little further to the east. They aren't saying at the moment that those must be part of an initial deal, but they are also saying that they do belong to Russia. There would be a ceasefire there. They would not renounce their claims. So the Ukrainians and the Russians are a long way apart. And when President Vance says that, you know, they're suddenly talking about details, well, actually, at the levels they're talking now, they've been talking all through the war. Yeah. The question is whether President Putin will meet with Zelensky, and we still have no sign of that.
Well, and we are also learning that Moscow wants to be part of the security forces that remain in Ukraine, possibly bringing in the Chinese as well. Is that also, I imagine, a non-starter?
Yes, it is a non-starter. I mean, it isn't just in this instance, but in general, in these kinds of situations where you're introducing a peacekeeping force, you would use forces that are sympathetic on either side, sympathetic to the local populations, etc., on either side of an area that is being carved out as a band as a buffer zone, if you like. So far, there's no discussion of having that kind of buffer zone. It's simply the Russians saying, you give us territory, that is on your side, and otherwise there is a ceasefire line. We keep everything that we have occupied so far. So we're only talking about putting a peacekeeping force on the Ukrainian side of the lines, and there's no reason whatsoever that they should agree or would agree to have opposition forces, what they see as opposition forces there.
All right, Mark, great to get your take on this. Mark Champion covers geopolitics for us. He writes for Bloomberg Opinion. You can check out his work by typing OPIN-GO on the terminal or searching for it on Bloomberg.com. This is Bloomberg. Time now for your front page news. First up on the New York Times, Israel approved new settlements in the heart of occupied West Bank. Under the plan, around 3,400 additional housing units will be built on one of the most sensitive tracts of real estate in the West Bank, called E1. According to Israel's finance minister, the idea of a Palestinian state is being erased from the table. Next up, the Financial Times reports that China turned against NVIDIA's AI chips after Commerce Secretary Howard Lutnick made insulting remarks. FT sources say Chinese regulators dissuaded domestic tech companies from buying the H20 after Lutnick's comments that the U.S. isn't selling China its best tech. And the Washington Post leads with the impasse in peace talks between Moscow and Kiev. Days after the White House celebrated splashy summits with leaders of Russia and Ukraine, the Kremlin signaled that its position has barely changed, complicating any path to an end to the war. This is Bloomberg. It is 5:30 a.m. in New York City. Good morning. I'm Matt Miller in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Tech pressure has been waning. Equity futures cooled down after days of sell-offs. The dollar hits a fresh 2-week high. That's ahead of the Jackson Hole Symposium that kicks off as the latest Fed minutes highlight concerns about inflation, but that came out before the horrible jobs revisions. And retail earnings continue with the biggest in the world, Walmart, on deck, as well as Ross Stores. So we'll see what that discounter is doing. In terms of what's going on in markets, we have seen NASDAQ futures fall lower. They were up overnight, and right now you're looking at red arrows. Not much change there on either S&P or NASDAQ futures, but both of them are down. In terms of what's going on in the Treasury curve, you can see the 2-year yield right now at 3.75, barely moving. In fact, nothing on the curve is moving that much. 4.30 on the 10-year, 4.90 on the 30. So it looks like traders or investors just sitting on their hands waiting for Fed Chair Jerome Powell to speak. For some stocks to watch, let's get back over to London. Valerie Teitel joins us with some of the individual movers. Valerie?
Good morning, Matt. I want to start with some earnings you got out last night. One of them from Coty Brands. Now, this is a massive conglomerate. They own companies like CoverGirl and Rimmel, big in the beauty and perfume space. That stock is down nearly 24% so far in pre-market trade. They came out with an unexpected loss of 5 cents per share. Market had penciled in a 2-cent profit. They also forecast some pretty steep sales declines. Now, this comes back not necessarily feeding into the tariff discussion. It's more on the fact that this is a struggling retailer that has really failed to turn around. It's near at the end of its 5-year turnaround plan and still having some issues. That's Coty Beauty, down 24% in pre-market. Let's move on to the tech space. CoreWeave is moving decently higher this morning, up 1.7%. This is on the back of some regulatory filings that showed that Jane Street took a passive stake in the company of around 5.4%. So stock really liking that news this morning. And lastly, let's take a look at what's to come. Walmart is reporting earnings before the bell. Not only are the U.S.'s largest employer, but they are known as a proxy for how the consumer is holding up. Those shares are in the red so far this morning, trading down 1.5%. Now, the expectations for this stock, Matt, are quite high after their conservative guidance they gave in the previous quarter. So let's see if they will deliver.
Yeah, absolutely. Looking forward to that in just about an hour and a half's time. We'll get the numbers. Valerie Teitel, thanks very much, Valerie, giving us the single stock stories out of London. Now let's get to the macro picture. It's day one of the Jackson Hole Symposium. Following the release of the July FOMC minutes yesterday, Bloomberg's Jill Desis joins us now. And Jill, we got a look at the concerns from the FOMC on inflation, but that came before some really significant downward jobs revisions.
Yes, that's right, Matt. I mean, look, I think when you're looking at those FOMC minutes, what was really interesting is just how many of those Fed board members were focused on inflation as being the bigger concern out of that dual mandate of inflation and jobs. But as you mentioned, I mean, since that meeting was held, we've certainly had, a lot of data that, has kind of, shaken things up a bit. And, that jobs revision number in particular. So I think what will be particularly interesting when we're going into Jackson Hole this this week is looking at that Friday speech from Jerome Powell. Does he say anything that's going to give us any further hints or clues as to what the Fed may be thinking for September? I mean, again, it's one thing to look at those FOMC minutes. Maybe you get, a little bit of a view, but just because there's been so much since then, because we're expecting additional data, I think really kind of looking at those Powell comments for any further clues is going to be really vital. I think as we've been discussing, he's certainly used this Jackson Hole in prior years to kind of give that hint of where the Fed is ultimately going, what that trajectory may be. Will he do that this time around? I think, that's what we're all obviously waiting for.
All right, Jill, we are waiting for it here as well. Jill Desis there talking about it from Hong Kong. The world really waiting for Jerome Powell to speak. And joining us with her take is Kelsey Berro, fixed income portfolio manager at JPMorgan Asset Management. She joins us here bright and early on set. Kelsey, great to have you here. What do you expect from the Fed chair? Because we have seen the probability of a rate cut as priced by futures or overnight interest swaps in the market continue to fall.
Right. So right after the jobs report, the market priced in a very high probability of a 25 basis point rate cut. Then we got the CPI data, which was mixed, but it came in essentially at expectations. What caused the market to start to reduce the probability of the 25 basis point rate cut, which is still the base case in the market. It's still 80% probability. You had the PPI data, which is a little bit hotter than expected. And now I think people are starting to prepare for the possibility that Powell is going to be a bit more balanced, more consistent with the press conference that he gave after the July FOMC meeting. Our view is that he's not going to commit to a rate cut in September. So those who are expecting more of a clear signal of, yes, we're going to go, similar to what they did last year, I wouldn't necessarily expect that. What I would want to see is a market that kind of continues to trade around where it is now. And he should be looking to let the data guide the market pricing rather than his own commentary. So that really puts a lot of the emphasis on the August jobs report that comes out at the beginning of September.
And what about the inflation numbers that are coming out? Because, as you say, core CPI was widely in line with expectations, but still rising rather than falling towards the 2% target at 3.1%. And I think a lot of economists, and correct me if I'm wrong, expect the brunt of the tariff caused price increases to hit later in the third quarter or even in the fourth quarter. So that's still coming.
Yes, I would agree. It is still coming. And it's interesting to hear some of the earnings calls from the retailers, for example, Home Depot earlier this week, saying, we're actually still working through the inventory that we generally shipped before tariffs happened, and we are still expecting to raise prices somewhat over time. So I think actually the surprise as it relates to the tariff impact is that it's going to be a slower burn over time, and it's almost more like kind of rolling impact. Each company is on their own schedule, dependent on the specifics of their market, the specifics of their consumers, the elasticity of those consumers in terms of how willing are they to bear the prices. And so I do think we're going to see it, but it's going to happen more gradually over time. Now, for the Fed, that's kind of in the price. They know that core goods inflation is going to rise. And I think what they're more focused on is core services and then inflation expectations. So if you look at like the 6-month run rate on core services CPI, that actually reached a new cycle low in the last report. That's been a function of shelter prices moderating. We've seen wage prices moderate. We've seen inflation expectations remain anchored. Those are the things that give the Fed confidence that ultimately, even though inflation is not making progress and is not expected to make progress on a year-over-year basis towards a 2% target in the short term, that they can feel comfortable that over time, they're still credibly moving towards their goals.
What do you see the curve doing? Does it continue to steepen? Because yesterday, Katie Greifeld reminded me that, at the beginning of this rate cutting cycle, even as the Fed was cutting the federal funds overnight rate, we still saw the 10-year yield rising. So does that steepening continue to happen?
I think generally we are in a curve steepening regime, whether it's the U.S. or you look at other countries like Germany, the other European government bond markets. We're seeing steepening trends there. I will say it is a very subscribed trade. It's generally something where many investors are expecting it and positioned for it. So you could argue that positioning is a bit crowded and susceptible to shakeouts. More recently, if you look at 2s10s, for example, in the U.S., the trend and the range has actually been pretty narrow between 40 and 60. We haven't been able to break out steeper in the last few months. The majority of the steepening happened right around Liberation Day, and since then we've kind of been trading in a range. Ultimately, what gets the curve steeper is going to be, in our view, the Fed cutting rates more aggressively. That brings down the front end rather than a material sell-off in the long end, given we view valuations at the very long end and term premium to already be fairly lofty.
What do you think about corporate credit? Because even investment grade spreads are super tight. Even junk spreads are very tight. At the same time, we're looking at the most bankruptcies that we've seen since the COVID pandemic. So what's going on there? Why are we looking at such tight spreads when companies are filing for protection from creditors?
Well, this may be a bit of a disconnect of, which companies are we talking about? So when you're talking about the investment grade or the high yield market, and we look at those corporate fundamentals, default rates in the high yield market have been very low, and corporate fundamentals in the investment grade market have been very solid. And I think those all support and justify narrow spreads. Now, what keeps them narrow is ultimately going to be demand for credit. And the reason that we've seen demand for credit despite narrow credit spreads, one, of course, the corporate fundamentals are relatively stable. They're starting from a high starting point. But I think it's also the all-in yield that's attracting people. So if you look at high yield, for example, the spreads in the 5th percentile or maybe even narrower versus history, the yields are in the 50th percentile. So, that's actually still a decent kind of starting point for investors, and spreads are just one metric of valuation that people are looking at. But, the other one that is very compelling right now is that all-in yield.
It's a great point. It's a great explanation, Kelsey. So the bankruptcies are coming from the kind of companies that aren't necessarily selling debt, certainly not investment grade credit. Great to get your take. Thank you so much for joining us at 5:30 in the morning. Kelsey Berro there of JPMorgan. Let's get to your other top stories trending on the Bloomberg terminal this morning. Ukrainian President Volodymyr Zelensky pushed back against Moscow's idea to add China as a security guarantor in the event of a ceasefire. Meanwhile, Vice President J.D. Vance told Fox that negotiations over ending Russia's war on Ukraine are focused on security guarantees and territory Russia wants to control. Fed Governor Lisa Cook has a message for President Trump that she can't be bullied into stepping down. In an emailed statement, she said she had no intention of leaving the Fed, despite the president's call for her resignation over allegations of mortgage fraud. A resignation would create another opening for Trump to fill on the board of the Fed if it happened. And Palantir's 6-session losing streak hands a rare win to short sellers. The losing streak wiped out more than $70 billion of the company's market cap. Data from S3 Partners shows that the drop has given short sellers $1.6 billion in profits. Shares are down 17% from a record all-time high earlier this month. Coming up, it's been a tough week for tech. More on the sell-off and Google's AI push as well next. This is Bloomberg.
We're going through this kind of AI fatigue, if you will. Everyone's saying that they have something better, a better mousetrap. Every buyer's holding off. Users are like, look, I've got enough. So we're just in this digestion phase. We are very encouraged about what will happen long term. But again, this is classic of a new technology unveiling. It's just going to take time to acquire, get the taste of it, and use it in the way that is helpful. So none of this is surprising.
That was Brent Thill from Jefferies reacting to the latest sell-off in tech, a two-day sell-off that may extend its weakness after shaving 2% off the NASDAQ 100. You can see that we have little change right now when you look at futures. We have been up, we have been down, and the open is in less than 4 hours from now. Joining us to talk tech is Bloomberg's Tom McKenzie. He hosts Bloomberg Tech Europe. He's been covering the sector for us on multiple continents for years. And Tom, what do you think of this sell-off? I mean, valuations had hit such an incredible high. I was marveling at Palantir trading at more than 100 times sales forecasts. That's something you don't see very often. Does this just look like a breather, the pause that refreshes, or are investors repricing the risk?
Yeah, I mean, you saw some of that buy the dip move, didn't you, amongst retail investors yesterday, even if you ended the day in negative territory. Again, as you said, for the NASDAQ 100, Palantir is, as someone described the valuation of Palantir at kind of nosebleed levels. The stock is obviously still up around 100% year to date, so the best performing stock in the S&P 500. But you have seen that. I think the market cap is off about $70 billion just in the last month or so alone. So the short trades in Palantir finally paying off for some out there, with gains of around 1.4 billion for some of the short holders of that stock, some of those shorting that stock. Although overall, of course, year to date they're still firmly in the red, at least on a kind of paper value level. So Palantir is maybe on its own kind of world, given the valuation that you highlighted there. What are the catalysts? Is it a bit of profit taking ahead of what we hear from Jay Powell if he pushes back and if rates stay higher for longer in the US? Even though most mega cap tech companies actually do pretty well in a high interest rate environment, they actually make more money on those interest rates than it costs them. Or is it just the run-up, the momentum, when you hear from people like Howard Marks saying that we are in the early stages of a bubble? Even Sam Altman of OpenAI in recent days has said that there's a little bit of hype, a little bit of froth when it comes to investor expectations around AI. It could be a number of those factors all together, and you would suspect that the Jay Powell, what we hear from him on Friday, is going to be one of those factors, Matt.
I will say Altman said they're going to spend trillions of dollars, talking about what OpenAI is going to spend by themselves on AI infrastructure. And I think that's really a fascinating story. But Google also is active in the news, putting out a whole new list of things, from phones to watches to earbuds. Are they really trying to make a push to take share away from Apple? Has that been successful?
I mean, so far, you haven't seen a lot of evidence that people have been switching out their Apple iPhones for the Pixel. They've got the Pixel foldable phone that's coming out late in the year, flagged for around October. That does remain a key question. Look, if the AI piece of this can work for Google, then maybe you get to a tipping point, a pivot point, a moment where people really start to break out of the Apple ecosystem that proves so sticky for so many. But it probably does come down to Gemini. And increasingly, you're getting the sense from Google that they're very confident about Gemini. They're embedding it in all of these hardware devices. They've played that catch-up story with OpenAI and ChatGPT. They feel like they're matching, if not exceeding that. And certainly, they're doing a victory lap around Apple at this point.
All right. Great delivery. Interesting stuff there, Tom. And I loved watching your show. I was up early this morning, so I got to watch your television program. Fantastic job. Bloomberg Tech Europe host Tom McKenzie talking to us about the sell-off that may continue today in tech, and the new product offering from Google, Gemini, could help them finally break people out of the Apple ecosystem. But that seems to be a pretty long bet. Let's turn now to private markets. Our own Danny Berger spoke with Blackstone's Vern Perry, global head of strategic partners, about the continued upside in secondary markets.
If you think about where the secondary market has come over the last 25 years, 1.3 billion in 2000. It was roughly 0.5% was the turnover rate. And the turnover rate is what percentage is the 1.3 of the total available dollars in private market funds. This year, I predict it to be 220 billion. That 220 billion will only represent roughly 1.4% of total available dollars in funds. It's tiny. I think secondaries is the most underutilized tool in private markets. I think that turnover rate should be closer to 9%. And that 9% is decades away, in my opinion, but the growth potential from here is enormous.
Well, part of the reason there's been so much growth, even just looking at this year and last year, has been deal volumes have been slowing. People are looking for liquidity sources. If we get deal volumes that pick up, and there's lots of predictions that it will happen, and we get some of that unlocked, does that slow the volume at all?
Great question. The answer is no. If you think about last year, 2024, that was a record year, 160 billion of volume, secondary volume. The previous record was 2021. We all know what was happening in 2021. Lots of volume, lots of IPOs, lots of M&A. That did not slow the secondary market. And so what I would say, whether it's a slow market or a robust market, the secondary role is going to increase over time as a solution to private market investors.
So you're talking about something very structural then, that is shifting. What does that mean for how this industry, how funds think about liquidity and exits more broadly?
Yeah, well, let's think about LPs. If you think about the reasons LPs access the secondary market, it's multiple reasons. The first one, though, is a huge misperception. People assume if you're selling on the secondary market, you're distressed. You're admitting defeat. You don't like the GP. Nothing's further from the truth, frankly. Most people are selling due to active portfolio management. They're reducing the administrative and monitoring burden of holding so many funds, or they're crystallizing gains to play offense, to reinvest in GPs and funds that they like. You're right. Over the last 3.5 years, distributions have been quite slow. Distributions down 40 to 50% in 22, down another 50% in 23. We're starting to see that trend reverse. 24, it was up 30%. Year to date, 2025, it's up 25%. So yeah, people are selling to generate DPI, distributions to paid in capital, or liquidity. But the most common reason people access the secondary market is for active portfolio management.
What does it say, though, that you have something like credit, for example, growing really rapidly in secondaries? Because that is supposed to be a thing that maybe is shorter duration, you get a return to investors more quickly. What does it mean if credit all of a sudden is becoming another hot part of this market?
No, it's a fair point. I recognize that. Credit should be self-liquidating. If you wait long enough, you'll get your cash back. But I think with that, that ignores the point of what other options do investors have. Someone may be looking to liquidate credit positions, frankly, to reinvest in another asset class that they feel is higher octane, or just frankly to lock in gains.
Danny Berger's interview there with Vern Perry of Blackstone. This is Bloomberg. Let's get a look at what's ahead today. Walmart reports earnings before the bell this morning, just about 1 hour's time. Numbers you want to pay close attention to because they will tell you a lot about the U.S. economy. Also on the U.S. economy, we have the Jackson Hole Economic Symposium. It kicks off today in Wyoming. Tomorrow we hear from Fed Chair Jerome Powell. We will hear from Schmidt, Bostic, and Goolsbee throughout the day. And as I say, that's all capped off by the chair's speech on Friday. Well, special coverage of that. In terms of movers, Cody, as Valerie Titel has been telling us, forecasts steep sales declines to continue as retailers clear out existing inventory. You can see those shares down 22%. Walmart falling ahead of earnings that come out in an hour. And HP Enterprise, Morgan Stanley raising that to an overweight, citing the recently closed Juniper deal. This is Bloomberg.